Hey guys, welcome back to a brand new video. I'm RexFinance with the rally cap on because the stock market continues to rally. And yeah, I know this might be a culture shock to a lot of you because I haven't worn a hat on this channel in probably a year and a half to 2 years. But yeah, I'm still RexFinance. We're still going to discuss the stock market on this channel. I just thought I'd better put on the rally cap because we have evidence today that I'm going to break down really quickly in this video that is signaling that this rally in the stock market maybe has only just begun. And that's saying a lot because the NASDAQ has already rallied over 15% from lows. But I'm not going to waste any more of your time. If you're new here, returning, not yet subscribed, don't waste my time. Hit the subscribe button down below. Without further ado, let's jump into this. So if I were to ask you what these stocks have in common that are on the screen now, you might be dumbfounded, like Clorox Company, Coca-Cola, Boston Beer, and Google, Facebook, PayPal, and AMD. There is no correlation here other than the fact that the top three stocks are red today: Clorox, Coca-Cola, and Boston Beer. But looking at these 7 stocks here, just 7 stocks, we can dive a little deeper and figure that the market still probably has a lot of rally left in it. The Clorox Company, a company that is growing at 2% or less annually, might I add, is trading at a forward PE valuation of 28. Now, that is not necessarily uncharacteristic for this company, where they trade relatively high in their valuation because their earnings, their profitability, their revenue is so sticky. Even in recession, people are still buying Clorox's products. But again, this year in 2022, the analysts are expecting Clorox to actually have negative 2.5% growth in revenues, and next year to correct that with positive 2.4% growth in revenues. This is not a growth stock, and it's trading at a forward PE valuation of 28. The Coca-Cola Company is the same way. The company is growing at 4% every year, and their forward PE ratio is a 26, and this actually is high for Coca-Cola. Typically with Coca-Cola, it trades just around 20 with its forward PE. Right now, again, it's at 26.25, and it's growing revenues at just 4% annually. And then lastly, the Boston Beer Company is trading at a 31.45 forward PE ratio, which is just ridiculous. This company generally trades at around that 20 to 25 range, and it's at 31.5 right now. Analysts also expect negative revenue growth for the Boston Beer Company this year in 2022, but next year in 2023, they expect 6.5% revenue growth, which is respectable. It's still somewhat of a growing company, but the 31.5 forward PE ratio is ridiculous. Now, in contrast to all of those stocks, we have Alphabet, Google, trading at a forward PE of 21.64, when this company typically trades at over a 30 PE ratio because the company is growing at 20% or more every single year. Facebook, or Meta Platforms, now has a forward PE ratio of 14.5, and typically this also trades at a forward PE of around 30. PayPal Holdings, forward PE of 22.37, typically in the 30 to 40 range with their forward PE ratio. AMD, 22 forward PE, typically is in the 40 range with that forward PE because of their growth potential. Apple, also here, trading at a 25.45 forward PE currently, which typically, Apple also trades at around a 30 forward PE. Now, the reason I am comparing these two different groups of forward PE ratios is because it tells us how backwards the market still is right now, where investors are assigning more value per dollar of earnings that Clorox is bringing in and that Coca-Cola is bringing in than they're assigning for each dollar of future earnings that Google, PayPal, Facebook, etc. are going to bring in the future. This is a completely backwards market. There is really no reason that the market should be paying more for Clorox's future earnings than Apple's or AMD's. And the only time this really happens in the stock market is when the stock market enters extreme fear, where they want to put all of their money into something that is extremely safe and sticky, like beer, soda pop, and sanitary wipes. In any healthy market, higher growth stocks will typically always have higher forward PE valuations because of their growth potential that Clorox and Coca-Cola simply don't have. The market is essentially calling BS on these higher growth companies right now, saying, we don't believe you're going to meet your projections in your guidance. We don't believe you're going to grow your business as much as you say you are. to some degrees, that has been proven true this earnings season, with a lot of companies cutting their guidance and cutting their outlooks and slightly missing on their earnings. But people forget that the stock market is always pricing things in. The stock market was pricing this event in way ahead of time, and typically the stock market has a tendency to overreact when it prices an event in, whether that's the upside or the downside. So whenever that catalyst actually takes place, the markets do the opposite of what you might think would happen. This is why, despite earnings and outlooks being cut, in kind of a meh earnings season, the stock market continues to roar higher and higher and higher. And this is also why there's very limited downside no matter what right now, because the stock market has priced in bad earnings reports and bad guidance. And there's going to be people out there that tell you this is unsustainable. We can't rally like this and keep this going, but I'm going to tell you that I think they're wrong, and there's one simple reason for that. If we look at average valuations over the past 23 years for basically all of the prominent stocks in the stock market, we can see right now that small cap stocks have historically low valuations. Only 2 times in the past 23 years have valuations on small caps been this low. We can also say the same thing with mid cap companies, and then we have the large caps, which finally have started coming down in valuation. And this is probably why over the past couple of days, you've seen the market indices kind of be flat. Apple stock today was down when a lot of other stocks were up 5 to 10%. This is because large cap valuations are not nearly as undervalued as mid cap and small cap valuations are currently. And typically it's the small caps and mid caps that lead you out of a market bottom and lead the rally back up. And looking at these average valuations right now, small cap average forward PE valuation right now is 12.2. That is still historically very, very low. That is still at levels we've only seen 2 times over the past 23 years. Mid-cap valuations, average of 12.6. Same exact thing here. And this is why I believe there is still significant upside for this market rally. There are a lot of stocks out there that are trading below their total cash value. Their market cap on the public markets is less than the amount of cash they have in the bank. If you think that's normal, I don't know, something must be wrong with you, but that is not normal. That is not a normal market. And it is not normal either that you would pay more for Clorox's earnings than you would for Apple's earnings. This is going to change over time. Obviously, I've been wrong in the past on this channel. I could be wrong about this, but I think that this rally, although it's going to be choppy, it's going to be up and down, I do believe that we've found the bottom, and this is the beginning of a rally. But anyways, I'm going to leave it at that. Let me know down in the comment section below what you think the market is going to do. Do you think this rally is legitimate, or do you think we're going to fall right back down? But with that, I hope you have a great rest of your day. Stay blessed. We'll be back with a brand new video later this week. Peace out.